The storm desk. Read the storm, book the roofs. You closed a strong month. The board says revenue per square is up, so you tell yourself the storm work is finally printing money. Then payroll lands, the bank balance disagrees, and you can't tell where the cash went. By the end of this, you'll know the real answer to where roofers make money. Insurance versus retail. Not the slogan that insurance pays more. The honest version. The payer doesn't set your price. The payer sets the workflow around the money, and that workflow is where the margin lives or dies. One number on that board is lying to you right now. Start with the number that lies. Revenue per square. A square is 100 square feet of roof. That part is standard. Almost nothing else is. Most shops report one blended average and argue about it. The fix is 3 numbers, not 1. Signed, what sales closed. Invoiced, what you billed for the work you did. Collected, what actually landed in the bank. On a cash job, those 3 sit close together. On an insurance job, they can spread months apart. Blend them into one figure, and you've hidden the entire problem. Now kill the slogan that insurance pays more. The same shingle on the same house lands in the same physical range no matter who writes the check. In 2025, an asphalt re-roof prices roughly $200 to $700 per square installed, depending on the shingle line. The carrier's approved price and the cash customer's accepted price both live inside that reality. When an insurance job posts a bigger number, it is almost never a secret insurance rate. It is more roof. Scope, not payer, moved the number. So where does insurance revenue legitimately come from? 2 places: supplements and code. A supplement is a formal request for funds the adjuster's first scope missed. Drip edge, the metal at the roof's edge. Starter strip, ridge cap, flashing, ice and water shield where code requires it, under quantified squares. Documented with photos, code citations, and manufacturer specs. Code upgrade coverage pays for what current code now demands but the old roof never had. That's real, defensible money. A cash customer might decline those exact items. So an insurance job carries more revenue per square, correctly attributed to scope, not a payer premium. But supplements aren't free. They cost office hours. Every line item you chase is a billable person, making calls instead of selling. The reason the slogan feels true is that nobody loads that cost. Here's the discipline. One line item gets 4 legs: a photo, a measurement, a source, and a price. A supplement that reads like a code memo gets approved. One that reads like a complaint gets denied and burns a reinspection. Build the packet right the first time, or your insurance margin is fiction you only discover at year-end. Now understand how the insurance check is built, because the structure is the whole difference. 2 settlement types run residential roofing. Replacement cost value pays the full job, minus depreciation for age and wear, minus the deductible as a first check. The held-back depreciation, called recoverable depreciation, releases as a second check after you finish and document the work. Actual cash value subtracts depreciation permanently, no second check. The homeowner covers that gap themselves. Same approved scope, 2 completely different collection paths. Here's where roof age quietly changes your revenue. Carriers are shifting aging roofs off replacement cost. Reporting across 2025 and 2026 describes a threshold age, commonly around 10 to 15 years for shingles, after which storm damage settles at actual cash value instead of full replacement. Some markets non-renew older roofs outright, so a street of 8-year-old roofs is mostly clean replacement cost work with a 2-check path. A street of 18-year-old roofs is a minefield of depreciation gaps the homeowner may never fund. Same storm, same street, very different money collected. Now flip it. Where does cash retail win? Speed and certainty. On a cash job, you sign once with the decision maker, set your own schedule, and collect close to signed, fast. No adjuster, no reinspection, no depreciation withheld, no mortgage company endorsing a check, no supplement cycle. Predictable collection is worth a lot, even at a slightly lower top line. And here's the part owners miss. When a roofing company sells, buyers discount storm revenue hard and pay full multiple for durable retail. Cash work isn't the smaller game. It's the steadier one. Watch one trap on the cash side. Finance retail is not the same as cash. When a homeowner funds the roof through a financing partner, the contract looks like cash. The P&L doesn't. Financing carries a dealer fee, often a real slice you absorb, which quietly trims your collected revenue per square below the signed number. And a deal can fall through after signing if the financing gets declined. a cancellation, not a collection. Tag financed work separately, folded into cash retail, and both the fee and the fall-off vanish into an average that looks healthier than your bank account. Walk the insurance collection timeline once, end to end, because this is why signed and collected sit months apart. The homeowner files. The adjuster inspects and writes a scope. The first actual cash value check arrives, scope, minus depreciation minus deductible. You build the roof. If the scope missed items, you submit supplements, which can take weeks, and a re-inspection. You send the completion packet. Photos, paid invoice, certificate. Then, and only then, the recoverable depreciation check releases. Count the gates in that path. An adjuster, a supplement reviewer, maybe a re-inspector, maybe a mortgage company. A cash job has none of them. Here's the line, and it is not subtle. The fastest way to wreck every revenue advantage from storm work is the deductible. You cannot waive, rebate, or absorb a homeowner's deductible. By industry counts, at least 28 states make that illegal, and it is insurance fraud on top. In Texas, the Department of Insurance requires contracts on settlements of $1,000 or more to state in writing that the owner must pay it. You also cannot act as the contractor and the public adjuster on the same claim. You document conditions and write an estimate. The insurer decides coverage. The homeowner owns the claim and pays the deductible. There's a revenue reason that line belongs in a revenue talk. Deductible games and adjuster overreach produce dirty revenue. It looks strong at signing, then collapses into cancellations, complaints, and legal exposure later. A per square benchmark inflated by jobs you should never have signed is worse than no benchmark at all. And your advertising has to be true. The Federal Trade Commission requires claims to be truthful and substantiated. Insurance approval, guaranteed. Free roof, we beat any scope. Those draw complaints and demands for proof you won't have. Keep the offer clean, and the dirty revenue never enters your book. So build the grid that actually decides your payer mix. Lock one denominator. Measured squares for signed, completed squares for invoiced and collected. Then tag every job honestly. Cash retail, cash financed, insurance replacement cost, insurance actual cash value, mixed, repair. Each month, read signed, invoiced, and collected per square by tag, plus average days from signed to collected, plus a margin estimate. Now you can see it. If the actual cash value tag shows a big gap between invoiced and collected, that's a depreciation gap problem, not a pricing problem. The grid turns an argument into a decision. Here's where RoofPredict fits, and where it doesn't. Once your grid shows which roofs you collect cleanly, point outbound at exactly those homes. RoofPredict pairs an estimated roof age range with storm physics modeled per individual home, so after a real storm you skip the brand new roofs and the deeply aged actual cash value outliers, and concentrate on the ages your data says collect best. It does not inspect the roof, diagnose damage, or decide coverage. Roof age is a range for planning, not an exact date. The list points the canvasser. The grid proves it worked. The inspection earns the sale. Close the loop. The payer doesn't set your price. Scope does. Insurance pays through code, supplements, and a slow-gated check. Cash pays fast and clean but smaller. Neither one wins outright. The winning mix is the one your shop can staff, document, and collect without surprises. Measure signed, invoiced, and collected by payer. Stay off the deductible. Size a cash reserve to the collection lag. Stop arguing about a blended number and start reading the three that tell the truth.